Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. I'm here with Jeff Perry, and I'm just laughing as I watched the video introduction. And by the way, if you listen to us on podcast, you can watch the video version of our podcast through our webpage. You can go to somethingmorewithchrisboyd.com. We also have some YouTube video, but it's a little harder to find still. We'll get to that eventually with an easier link for the YouTube page. But I was watching the video, Jeff, and there you are with your goatee.
Oh, I know.
How long has that gone away?
That was last winter. So
yeah, I'm kind of, I don't know. You're going to do it again?
Living in Florida, you got to get some extra insulation once in a while.
Yeah, right.
I don't know if I'm going to do it again. Probably.
Yeah, that was fun. Anyway.
Yeah. I do see it, and I go, oh.
We'll have to talk to Stephanie at some point. So help us redo our intro. Looks good, though. I like it.
I'll put it on the end of your
show,
planning.
Everybody. Yeah. Yeah, it'll be your end of your planning.
Right. Which is the title of this episode, by the way.
Yes, we are planning to talk about end-of-year planning topics and things to consider. Before we do, I just wanted to talk briefly about our recent move within town. We moved from one part of Hyannis to another part of Hyannis. We are now located at 1575 INO Road, which is Route 132. They're calling the financial district. I don't know if that's...
Well, if you look at the signs, you can see why. Right across, almost across from the Cape Cod Bank.
Yeah,
big headquarters there.
Headquarters. We got insurance company next door, an investment company next to that, an investment company next to that. So we got quite a few familiar names around here. In any case, our firm is Wealth Enhancement Group, and we are with the AMR team. And we put out the show each week, and glad you're here. Thanks for being with us. But with our recent move, we had a little ribbon cutting event.
Very nice event.
It was very nice.
Cape Cod Chamber.
Cape Cod Chamber was the sponsor of it.
Yep.
And some of your clients came, and one of whom was Matt Levesque, and sang for us.
He did. And for the people who don't know Matt Levesque, he's a town councilor in Barnstable, and he announced it. So he's associated with our firm. And the reason he sang is that Representative Steve Exaros was there.
And put him right on the spot.
And just out of the crowd, Matt can sing.
Yeah, the poor guy. And he did a fabulous job. It was amazing.
He was all warmed up. He had just come from another event.
Is that why he was able to
I think that's why
right
Steve,
into it? Wow.
Representative Exaros said, oh, he's all warmed up. He can do this. And to Matt's credit, he jumped right in.
He did. And Steve was so great that day. He came and read a citation from the State House, and he just did such a nice job. He has some nice comments, and it was a treat to have him join us as well.
Steve is one of those public figures who sincerely cares about the community and the people, who live on Cape Cod, and that's why he was there to celebrate the grand opening of the new office.
Very nice of him, and everyone who showed up. But just wanted to mention that and thank those public officials for being there, and meant a lot.
Yeah.
So,
thanks you to the Cape Cod Chamber too. They did a nice job.
Yeah,
they brought the big scissors and everything.
The big scissors were super fun. The big ribbon and everything. Yeah,
Kristen Boyd, your wife,
Yeah,
was a little bit too anxious with the scissors, so
she was loving them.
I didn't want to get too close to her.
Yeah, exactly. I kind of wanted to touch them as well, but it's
No,
like, no, she's got them. She's got it
she's got them,
covered.
and
No, this kid.
she completed the mission, cut
And
the
did it
ribbon.
fun. But those things were heavy.
I know. When the chamber told us they're bringing big scissors, I didn't really know they'd be that big.
They were the golden scissors. They were fabulous. So anyway,
It's a great new office, and our clients, the ones who were there, saw it, and our clients who haven't are certainly welcome to.
yeah, we'll look forward to having you come in, and those who may be interested in talking to us at any point, we'll be happy to have you here. We're in the first of the series of buildings that, well, it ends right around Mary Lou's Coffee. So you've got several buildings.
Yeah, the first driveway if you're coming like from Route 6 on the right.
Yeah,
after the light.
After that light, yeah. So in any case, glad to have this change, and incidentally, we've been in the same location with Boyd and Boyd, the law firm. My father and brother originally, now my brother's law firm. Unfortunately, the way we were able to find spacing and everything, we couldn't find the same kind of configuration where we'd be immediately either sharing the space or adjacent. But we are right across the parking lot, so they just moved in as well across the parking lot. So
Great.
we'll be making things still pretty convenient if people are looking for one-stop shopping kind of thing. Yep. In any case, let's talk about year-end topics that we wanted to get into, Jeff. It's the fourth quarter, and I mean, gosh, how quickly is this year flying by? I don't know. Maybe it's just me as I'm getting older, but it just feels like this year has gone especially quickly, and so much going on. But as we kind of enter the final phase of the year, and I mean, really, it's already gone almost a month seems probably likely gone by. So, right. When you think about it, the year is racing through. We want to talk a little bit about what are some year-end things to be thinking about for our listeners as they plan. And, the first one that comes to my mind is really for those people in retirement to be thinking about your required minimum distributions. It is that time of year that people kind of bring that top of mind. And, let's remember, if you have charitable intentions, you may want to, if you don't need the money, and you're over 70 and a half, for those who have required distributions, you'd be over 73 right now, but 73 and over. But in any of these circumstances, if you're 7.5 and over and have charitable intentions, you can use IRA money with a qualified charitable distribution. And that, for those who do have IRA distribution requirements, that does diminish your requirements. So if you do as much as your RMD requires as charitable intent through this process, you could waive your IRA required distribution. So now it's IRAs that this is relevant for, not qualified plans. But in any case, whether you have an IRA, a 401k, a 403b, fill in the blank, some type of retirement money, SEP IRA, simple IRA, and so forth. Not a Roth IRA, but just about all the rest. You have a distribution when you get to a certain age that you're required to do. And the way the calculation works is essentially they look at the value of your account at the end of the prior year and how old you'll be at the end of this year. And that factor is used to there's a life expectancy assumption that there's a table to come up with this on the uniform table. And we use that to say, how much do you have to take out? You divide the balance by the factor, and that's your number. So your custodian will usually tell you that number. You don't have to go figuring it out yourself. And we certainly, with our clientele, we reach out as it gets to this time of year to say, hey, don't forget if you haven't. Now, many times people will be taking it monthly, and it's part of our cash flow. Other times people say, I want to get it as money for spending at a certain time of year. I got a big bill for my insurance premium, or I've got a big bill for a tax item or something. But sometimes it's just, it's year end. I'm going to use it for some of my shopping and gifting and things of that sort. So whatever it is, this is the time of year, time to get on it.
I think it's especially important for people who maybe had their IRAs, RMDs, I should say, delayed because of the Secure Act. That, because it used to be 70 and a half, right?
Yeah.
And depending on where you are in that,
and then it's 73 and keeps changing.
That's right. So if you aren't sure, and you're a client, give us a call. And if you don't have to be a client to give us a call, but
sure. And if you're born after 1960 or after, it's worth knowing that for you, when the time comes, it won't be until 75 that you're required to take your distribution. However, you may want to do some planning to make sure that's appropriate to wait that long, because it can create additional tax burden by pushing you into higher tax brackets.
Yeah, the good news for the people who wanted to delay taking their RMDs is they had a few more years. The bad news is that when you take them, they're going to be bigger. Well, that may not be bad news, but it could push you into higher tax brackets, or it could mean a higher tax burden than you first thought. So there is some planning required in this. And speaking of taxes withholding, most people, I think, it's prudent to have taxes withheld from their distribution, not
totally agree.
Make it up in April,
not just put it off. You know, better to get what's net of taxes as money you can spend, rather than spend more than you really have, because, oh, by the way, there's a tax on that money and now you owe more money, from tax day. Nothing, I mean, some people prefer to just put it off and pay the tax, at the last minute, and you keep use of that money. I get that, but I have to say, there's nothing I hate more than having the accountant say, "Hey, you had a good year. You owe a lot of money in taxes," and not having prepared for that. You want to be prepared for your taxes.
Yes, absolutely. So both of these things are planning related, and the end of the year is coming. So,
hey, in the topic of IRAs as well, though, might be worth talking about inherited IRAs a little bit too.
Speaking of changing laws, yes.
Yeah. So the IRS has been waiving distribution requirement enforcement because of the confusion that came about since the Secure Act.
We're talking about the 10-year rule.
Yeah. So with the change in the Secure Act, that, we had this stretch IRA, and then if you inherited money and someone dies, say 2020 or after, you inherit that as a beneficiary of that IRA. Now you have an inherited IRA, or sometimes called a beneficiary IRA.
Yep.
It's not your IRA; it's the IRA of that person you inherited it from. And unless it's a spouse, when you can just convert that over. And there are some exceptions. If for example, if it was a sibling who was within 10 years, I think it is, you could still do a stretch IRA, or there's some rules around this that are some unique circumstances. But for most people, let's just keep it simple today. When you inherit an IRA, you have 10 years to take that money out. Okay, that part's simple enough. But if that person who died had already started their distribution requirements, had reached their required beginning date, you also now have to take money out each year. Now, the calculation for that is different. It's not based on their RMD. It's based on you. It's a different table than the uniform table.
And this is true even if you're not of the age for RMDs individually.
Yes. Even if you're, not yet 73 or, but if they were subject to the RMDs and you inherited that IRA, yes, you have 10 years to take the money out following the year the person died. So you've, over 10 years. Could take it a little bit each year, could save it to the last minute, could take it all at the beginning if you want. But if you keep that IRA in existence, that inherited IRA, you also are expected to take a modest required distribution, and the calculation, as I said, is a little bit complicated, but something you need to deal with. The IRS, because of this, has been confusing, frankly, and not clear in the way the law was originally written.
There were two different interpretations for sure.
But now it's clear. Mm-hmm. That's the way they're going to deal with it. You, in the future, at least, will have to take that additional, annual sum. Now, that's been waived again for 2024, so you don't have to, but you probably should be getting structures in place so you know how this formula is going to be calculated and what you're supposed to take.
Yeah.
And it would be prudent to start that process.
If you're thinking about long-term planning, I spoke to a client recently that doesn't need the money from this inherited IRA.
Yeah.
So his kind of deference was, well, let's just leave it there and I'll, have it for the future. And then he realized that in the coming years, he's going to be at the age of RMDs for his own investments.
And there's that much more that he'll have to take out. Yeah.
And so if he saves that for the period of time where he's now taking 2 distributions plus his other income, it's likely that he'll be in a higher tax bracket. And we're not even talking about the likelihood of higher tax brackets.
Yeah.
Separate issue. So he's decided to, although he doesn't need it, to start to take it in a period between now and when he would start his RMDs, so that he's not having to take 2 and piling on and perhaps getting into that higher tax bracket.
That's a great point.
So it's very individual.
Good planning. That was good thoughts for right. The planning. That's kind of the point. You need to be intentional about this, think it through, and not just because you can put it off doesn't mean you should.
Right.
You may want to be thinking about how this fits into the greater context of your cash flows and your taxable income. Some people, if you're looking at it and saying, well, I'm going to be retired in 2 years, so I might just wait, I'll take the minimum requirement, but then I'll take more money out after I'm retired or whatever, like my income goes down. Oh, that's good planning, right? It's a question of what's the rest of the story, as Paul Harvey used to say.
And now
the rest of the story.
Another mistake that people can make here is, and it's kind of a initial reaction from some people, they inherit something, they take it, right? It's not per se wrong, but if you have a lot of income in 1 year and you're retired and you're on Medicare, you can affect your Medicare premium. It's called IRMA. We've talked about it before. Stay away from IRMA.
Yeah.
It can affect your future premiums because you had that one big year of income. And so you might spike your Medicare premiums for a period of time.
Yeah, it's not forever, but it does. Right. It's a tax. It's a hidden tax, and it's a frustration that retirees, when they run into it,
they don't think about it because many of them don't know about it.
Makes them crazy.
Right.
I hate it.
Right. So get some good tax advice, get some good financial planning advice on all these things, and you can make the best decisions that will ultimately probably save you money.
So another year-end activity that you and I have been talking about, and Kristen mentioned with a case of a client recently, is to double check your beneficiaries.
Because your ex-wife might be your beneficiary.
That's right.
It happens.
That? Yeah,
it happens. Or someone who's passed away may be a beneficiary.
Right.
Or whatever it is, someone
who you want may not be the person who's currently set to receive your wealth when you pass. And beneficiaries can be associated with all kinds of assets. It can be IRA accounts and 401ks and 403bs and all the like of these, qualified plans, simple IRA, SEP IRA, fill in the blank. All of these, Roth IRA, inherited IRA, etc. Like all of those types of accounts have a beneficiary, but so do life insurance policies,
bank
annuities,
Yeah.
Some bank accounts. You're right. So transfer on death in brokerage accounts. We have these with some individual or joint accounts that people want to assign a beneficiary on the account, so it avoids probate.
Right.
All of these can have beneficiary designations, and it's funny. Account values fluctuate as you take money out or add money in or whatever it is. And you may want to revisit is, do I have this structured the way I intended? Because I was going to give these accounts to those people and that account to this person. Well, have those accounts changed in value in a way that still aligns with what you had in mind? Um, is there another way to do it? You get the gist. There can be a variety of things to be thinking about. And as you were mentioning, this just came up recently where Kristen, we try to do this as part of an annual review and, periodically just take a look at accounts. Kristen happened to check an account when doing some paperwork for a client who was making a withdrawal and said, "Hey, I just noticed your ex-wife is your primary beneficiary. You want to come down and sign those forms and we can update your beneficiary as well?"
3 minutes later, they were there.
He was there. Yeah. So got things up to date. But, that's a pretty, pretty big example of something where you go, "Oh, that's a big change."
It takes so little time in the scheme of the importance of it just to, sit down, have a list of your accounts and say, who is the beneficiary?
And it's kind of obvious. I mean, it's so obvious, but we take it for granted. But it's so often that it becomes like, oops, that's not quite.
And this is a age irrelevant thing. You can be
a
young person with a 401k and
people have a 401k they started before they got married, as an example,
True.
or an account of some kind, and it's like, oh, do you want that to reflect your spouse, that kind of thing. People, as you said, people die and I want to change. Who do I want that to be?
It's sometimes it's the wrong person, but I think more often there's no one there because people, they either open an account at work or they open an account with us or another advisor and they're not sure, right? Oh, I think I have a trust or maybe I don't. Let me look. I'll get back to you. Because they're not sure that they didn't anticipate that question when they were sitting in HR that was going to be a question, right?
Yeah, and have the estate as the answer. Definitely don't do the estate as the answer.
Not unless you're looking to make lawyers wealthier.
Yeah, because it requires probate.
Right.
If you leave it as the estate, and then if you don't have a will, well, it's not necessarily what you want. It's what the state says what their default option is. So these are things you should really control.
And
so an estate plan is
that's on my list. Do you have an estate plan? Great. If the answer is yes, great. And basic documents of a will, maybe a trust, depending on your circumstances, but at least a will, healthcare proxy, living will, power of attorney, durable power of attorney, the basic documents. But each year you should be asking yourself, is my estate plan correct? Is the estate plan that I've done correct? Did something change?
Someone or something that needs.
And it can be as simple as my children are no longer minors. Does that matter? To you or life?
How long before I want them to be eligible to receive these resources? Are they mature? Are they not mature?
That's a great point. So you can have in your trust or your estate planning documents that you appoint a guardian, or if you have younger children and there's a trust created until they're 18 or 21 or whatever it is. But you could have a situation where that's expired because the child is now 22 and you're leaving $2 million. Is it really the best thing for a 22-year-old to get $2 million of assets?
Right. Is that how you want to deal with it? Yeah.
Maybe not.
Maybe. Right. Yeah.
For some 22-year-olds, it's fine. And for others, you could be doing them harm. So, and everything in between, right? So review your estate plan. Was somebody born? Did someone die? Did someone get divorced? Did someone get married? All these life changes impact your financial plan, certainly, but they also impact your estate plan. So if you don't have one, you need one.
Yeah, and at any time of year is a good time to be thinking of this, but it's sort of as we kind of come to year end, hey, this is a good time to be just kind of stepping back, thinking about your planning. Oftentimes people do this as we start a new year, same kind of thing. It
Same
doesn't
idea.
matter whenever it is for you that you say, hey, these are a few things. There are some other things that we might want to talk about when it comes to year end specifically, but before we go on to those, you had also mentioned something about just life insurance, which
Life
is
insurance.
kind of related to the estate planning topic. And although it's not specifically year end planning per se, it's one of these things that, oftentimes people just need to reassess. Do I have the right amount? And I think the way you think about a life insurance is, um, if I'm not here to create an income
Right.
for my loved ones, um, what would be the amount I'd need to create through a money machine
That's
that
right.
could generate the income that they need? Okay, I want to replace my $100,000 income. I don't know, making it up.
Sure. Yep.
Um,
Nice to use
well,
round numbers.
what do I need in insurance to spit out from its earnings $100,000 a year?
Right.
Oh, I need 2 million, 2.5 million, or whatever the number is, right?
Yep.
Okay, that's a good idea of how much. Do you have the right amount of insurance in place, even if it's temporary? We tend to be in the school of thought for most circumstances, not all, but most circumstances, that we really don't want insurance forever. We just want it for long enough until we create the wealth
That's right.
that will be that money machine. Sometimes there are circumstances for estate taxes or liquidity needs. Oh, I own a business and it's not liquid. Oh, I might need some money to, there might be permanent reasons to have insurance in place. But for most people, the goal is to create the wealth and then not need the insurance.
That's
So
right.
term insurance can be a tool in that effort. Okay?
Yep. If you have children or, a dual income family or someone who relies on your income, is the best way to say it, as you did. You may not need life insurance if you don't have the assets that can support that person or have that person continue in the same lifestyle.
Yeah.
Then you probably need life insurance, and term is typically the least expensive. So
And these days, we were just talking about IRAs and things like that. Sometimes people do think of insurance beyond the temporary because they're saying, well, look how much I'm giving up to the government and I want to recreate that. Yeah, okay, that's a reasonable
there can
thought.
be legacy reasons. Yep.
It could be,
Yep.
that makes sense.
Very individual. But we're
Yeah,
talking about like the basic.
core reason.
Yeah.
So, all right, let's go back to tax planning and
Sure.
some of the kinds of things that are year-end planning considerations. So, we're talking about IRAs with distribution requirements, but on the other side, have I maximized my contributions to my work plan? Might still be time to defer salary if
That's
you
right.
wanted to,
You're able to.
maximize your benefits. So whatever that maximum contribution amount is, if you can afford to do that, still an opportunity before the end of the year. Similarly, if you want to contribute to an IRA or a Roth IRA, or you don't have to do that in April, of the following year. You could arguably be doing that now to try to get it in,
Yep.
get the money to work for you. Another one that came up recently are health savings accounts and FSAs, HSAs. These are employer benefits, and if you have such an option through your employer, maybe you want to look to maxing it out. An HSA is one of these hidden gems that we don't talk about very often, but all kinds of tax advantage benefit to using an HSA.
Yep. It's a real safety net for when you retire. It's not a retirement plan, but it's a great add-on to a retirement plan.
It can be used in all kinds of different ways. So, you don't have to spend it every year with your current expenses while you're working. Maybe it's a good thing to hang on to for when you're not working, to apply to helping you with some of your healthcare costs. But in the meantime, it's growing tax deferred. When it comes out, it's tax free if it's being used for these kind of qualifying healthcare expenses. So real advantage there.
Another thing that reminds me, something people could consider doing at the end of the year is if they have that capacity to save more and they're in a retirement plan, maybe it's time to click it up a percent. If they started it with the match and they're doing fine, maybe it's time to say, all right, I've been contributing 6% because it's matched. Maybe I can afford to do 7% next year.
Great, bump it up. I had something come up recently where someone was emailing. We're going to talk to her about this, where she's concerned her husband passed away, and some of her withholding throughout her various income sources hasn't been updated to reflect her as a single filer now, and her withdrawals from something is rubbing your microphone, just so you know. There we go.
Thank you.
Yeah. So she's getting these distributions and wondering, am I saving enough for taxes? Maybe we should be updating the tax structure for. I think she wants to talk about like her Social Security and some of these other pensions and things with her contents for IRAs. Easy to do. We just change what percentage we want to withhold, and we can, based on her financial plan, we'll just discuss, how much she probably should do based on a forecast of her tax planning.
Yep, that makes good sense. And it's not the case in every case if you under withhold, but if you do under withhold to a certain level and you do it more than once, the IRS can penalize you in addition to the tax for not withholding enough in the prior
it's just an extra cost. It may not be so punitive that it's a big deal, but who wants that, right?
Right.
For people who are self-employed or maybe high earners in certain kinds of work, you may have the option to try to defer income as you get to the end of the year and push it into a future year, whether it's some kind of plan where you have a deferral, or whether it's just how you plan your cash flows with your billings and stuff, depending on the circumstances. But that's another thing to consider for year end.
The corollary to that is you can accelerate expenses. If you have
that's a good point.
If you have an expense that you're going to spend, like, don't just spend to save taxes. People do that, and it's kind of silly, but if you have an expense you're going to have a need for in the first part of the year, and you have a good excessive amount of income this year that you'd like to write some more off, and you can legally accelerate the expense, go right ahead.
Yeah, good points. A topic that's come up over the last couple of years that's counterintuitive for year-end tax planning is the topic of a Roth conversion. It's actually planning for more tax now by doing a Roth conversion. But with the end of the Tax Cut and Jobs Act in 2026, some of these rates that are due to go up and the thresholds go down, so you get into higher tax brackets quicker. It very well may be worth consideration, but I think some of this comes. Most instances, people want to do a Roth conversion when they're not working, or if they make they have an off year, or maybe modest income or something, rather than otherwise. People in the highest tax brackets, though, probably already in the highest tax bracket, probably going to continue to be if they're doing their saving well and so forth. They also we think about sometimes Roth contributions, Roth conversions, things of that sort.
I think a good reason to put it on this end of year consideration of year-end planning is you may find it advantageous to spread this Roth conversion over 2 years. And if you're trying to stay, say, for example, if you're trying to stay within one of the current tax brackets, which are probably going up, as you indicated, but you've got 2 years to do that. So maybe you can take the amount this year up to whatever your tax bracket is that you don't want to leave. And then next year you can either do all of it or maybe do the same thing again. So these, we find people asking these questions sometimes get fixated on should I do a Roth conversion or not, and we have to remind them that it's not all or nothing. You can
Right.
do it
And
partially.
that's really important.
Right.
Most instances, not really done with a single conversion.
Right.
In most instances, people do these kind of things with, like you were saying, planning to like how much within a bracket, how much
Right.
movement do I want to, how much do I want to convert to be thoughtful about the tax consequence of that. And oftentimes that's over multiple years, not just a single year.
But we have 2 years left guaranteed of these tax brackets. So if that's something that's in your someday I'm going to think about this, it's probably the right time to think about it.
That's a good point. I also think about charitable giving, and the way this current law with the Tax Cut and Jobs Act works is that there's a pretty high standard deduction, and so most people are better served through that. They enjoy the standard deduction, but if you're going to be doing significant healthcare expenses or some surgery, some dental work, some hearing aids, all these different kind of things.
Some one-time things that might
If you can
add up.
bundle them in a given
Right.
year, it might make sense to do itemized deductions. If you have charitable intentions, bundling can sometimes be a good way to do that. Oh, I'm going to give multiple years of gifting rather than waiting to do it over several years.
That's a good
Uh,
point.
so this is maybe a good time to do if you're thinking about some of those kind of unusual strategies. I mean, the healthcare stuff may have just evolved, but it may be worth thinking about and doing a little dry run with your tax preparer to say, what else should I consider
Right.
if it would make sense? If it would make sense, how do I get better tax strategy in this unfortunate circumstance that I have?
Something already happened, right?
Yeah, some healthcare costs or whatever.
So do I need something else? Or could I
So-
use something else this year? Yeah.
There's probably other things, Jeff. You might have a few others, but one of the ones that I think is the obvious kind of as we move toward the back end of this conversation is talk to your tax planner. You probably have a tax preparer, and if they don't always necessarily reach out to you to say,
No.
"Hey, let's do some planning as we move into year end," but that doesn't mean you can't reach out to them. And especially for business owners, it's probably important to take this time to just do a little bit of check-in and say, how are we doing? What should we be thinking about? Excuse me.
It's a lot easier to reach them in October or November than it's going to be on February 15th through April 15th, right? So
Yeah, and you can't do anything about it then.
right.
Whereas if there is something that can be done, now's a better time to do that. Isn't there something about paying when you pay your estimated taxes too? Um, if like you have a January payment, maybe sometimes you want to pay it in the current tax year because that can also, when it's the deductible expense, you want it to be on the right tax year. I think it depends on whether it's state or federal, but you get the gist.
Yep.
Some
There
of
are
this
small
can be-
things that can all add up to real savings on your taxes and real greatest success in your financial planning. So they're both tied together, obviously, but don't wait until the end of the real end of the year, like December, to start thinking about these because you may not have time to do them.
And honestly, there's so much that you can think about, and it doesn't mean you have to do it all. You just trying to incremental progress. I think is one of the things that we oftentimes we get hung up on perfection, and
Sure.
incremental improvements are always good. So, well, if we can be a help in some of the planning, that's where we come in, where we talk about the basis of a financial plan
Mhm.
as the structure on which a lot of other things intersect. So, your portfolio design, some of your tax planning issues. By the way, we didn't even talk about capital loss harvesting and capital gains planning, which certainly we do as a matter of course
Sure.
with our managed discretionary managed portfolios that in a year like this, though, where second year in a row markets have gone up double
Right.
digit kind of returns, at least as it stands today. Um, it's very likely that there's not as much opportunity to harvest losses. But when you have gains, realized gains, it's attractive sometimes to, if you have some investments that have gone down in value, to sell those in order to offset some of the gains and then replace them with other holdings that can be very similar.
Yeah.
Just to help lock in some of that tax strategy.
Perhaps you have an old position of stock that you fell in love with a long time ago and you just don't want to sell it because of the emotional side of selling a loser.
Yep.
It might be a good year to do that, depending on the outlook of
Good
that
point.
given company. Don't do something just because of taxes, but
you can also, I mean, even in that scenario, if there's a good reason to hold something like that, you can either buy it back in a period of time, 30 days or
30
so.
days, yeah.
Or you can maybe use an ETF that has some of that position
Right.
within it, or you can buy something in that sector or something that's related, or there's other ways to maybe try to navigate that where you can still lock in that tax planning while still maybe retaining or access to or some exposure to that industry, that sector, that maybe even that holding itself. I started to talk about the idea of the context of this and planning. Tax planning is part of that. As we wind down, if you need help in thinking about your financial planning, you're in the context of this, we can be a participant in that tax planning conversation to help you think some of this through. And all these threads kind of end up kind of relating. So it's not the only thing to think about, as we always say, don't let the tax tail wag the dog.
Right.
But it's an important part of the conversation as well. Thanks, everybody, for being with us. If we can be a resource to you, don't hesitate to reach out to us. We're happy to be here. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.